Let's see if things are showing up. And welcome everybody
Welcome,
to
welcome.
Office Hours, where we answer live questions.
Mhm.
Let me mute all these tabs. Okay, so we're live on Facebook. That's working. Let's see. Click to join. We are live on Instagram, LinkedIn. Starts with an IN. It's got the icon. And then YouTube. Let's see if YouTube's working. It should be working. And yes, it does appear to be working. Okay, awesome. Love it when technology works. I actually found that um, right before I turned on the webinar that I had the wrong key in the streaming settings. So I'm glad I actually checked. Alrighty, so yeah, we're live. We are here on Zoom and we're streaming to Facebook, Instagram, Facebook, LinkedIn, and YouTube. And people can join us here in the chat. You can actually join the Zoom if you like. Go to taxsherpa.com/Zoom, and then I'll just redirect you to the Zoom login page. And yeah, this is office hours. This is where we talk about stuff that's going on. Let me share my screen so I can actually um, so that we can actually see what's going on here. I do have a couple slides. All right, here we go. Office hours Q&A. And we are taxsherpa.com. We'll get in a second as to what that actually means. But this is office hours. This is where we answer questions. Just like, back in the day, I was in grad school. I used to be a TA and I had office hours. I had to sit there and wait for students to ask questions. So it's a little bit of that where people have, we have clients that have written those questions over the last week or so. And also, if anybody in the live chat has any questions, we can hit those as well. And yeah, so let's dive into it. So, who am I? I am Neil, founder of Tax Sherpa. We are a tax advisory firm that specializes in helping solopreneurs, independent contractors, small business people reduce their taxes by 20 to 50,000 on average each and every year. And how Tax Sherpa evolved is kind of comes a lot out of my own personal story. So I realized early on, corporate world was not for me, and I can tell you exactly how that happened. I was sitting in an auditorium in the year 2000. I was interning for A&B. I was in school for engineering. I was doing electrical engineering stuff. And yeah, so they had an award ceremony, and there was a big product launch while I was there. So they were handing out awards. Joe got 3 patents, and Sally did this and that and the other. And then the last guy was Bob, and names have been changed to protect the guilty. But uh, so the intro for Bob was that he had a 2 week European vacation booked with his family, months in advance, paid for, approved by the company, yada yada yada. And because it became crunch time during the product shipment, he canceled all that and came into work. Isn't he such a swell guy? And everybody gives him a clap, and they give him a plaque, and and it was right at that moment. I'm sitting there in the company campus auditorium, and I was like, I remember having this thought. It's like this is not for me because I don't want that to be my life work balance. And I was only 20 years old at the time, but still, I was old enough to realize that this is not going to work with my personality.
Right.
And over the years since then, I am basically unemployable because I'm just one of those people who doesn't want to be told what to do about anything. So I went off on my own and I started my entrepreneurial journey, and lots of ups and lots of downs. And then in 2007, I started getting letters from the IRS saying I owed them $1.3 million. So that so if you have tax problems, I I've been there. First you get letters, then you get certified mail letters, and then you might get some phone calls, And then if you ignore all of that, which is what I did, which is what most people do, if you ignore all of that, then they'll start going after whatever they can find if you owe enough. So they'll garnish bank accounts, they'll go after your paychecks and all that kind of stuff. So they started garnishing my paycheck, and that got my attention. So over the next year or so, I was working on fixing my problems, and by 2011, I had hooked up with this former Wall Street tax attorney, and he kind of showed me the ropes. He helped me fix my problems, and he was at a stage in his business where things were growing, but he didn't really know how to run business stuff. He was great at taxes, but not so great at the business side. So I took all my entrepreneurial experience over the last 10 years. And I applied that to his business, and we tripled that over the next couple of years. Worked with him for a long time, and since then done 50,000 tax returns on billions of dollars worth of client earnings, and saving clients 20-30 million dollars a year. And so what became my mission was to help my tribe. And my tribe is all those other people who can't have a job because it just doesn't work for them. But the solopreneurs out there, the independent contractors, the small business owners, and the mission is for our tribe to get your quality of life back, because taxes are the single largest expense for most people. And if we can cut that down, we are getting you back time, we're getting you back money, and we're getting you back quality of life, because now you're working for yourself rather than working for the government.
Mm-hmm.
So that's how Tax Sherpa came to be, and that's our continuing mission. So here's a question for you. I know Office Hours is about people asking me questions, but here's my question. The quality of our questions determines the quality of our life. So my question is, what is the root problem with overpaying on your taxes? Like, I mean, yes, we know that, you're depending on what side of the political spectrum you're on, you either agree with the guys in charge or you disagree with the guys in charge. Even if your side is the people who are currently holding office, you know that down the line that's not going to be true, and you know that there are things that the government's doing that you're probably not a fan of. Again, doesn't matter what your affiliation is, that's just kind of across the board. Somebody's doing something with your tax money you don't like. So that's one issue. Another issue is, it's just money, right? It's money coming out of your pocket. That's a problem. But I don't think either one of those is actually the root problem. I think the root problem is that you're actually giving away your life. And so if you like an independent contractor, typically is going to be paying about 45% in tax when you combine the federal income, the state income, the self-employment tax, and then you could add in property taxes and sales taxes and all this kind of stuff. 45% ish is kind of what you're looking at. So what if we cut that to 25%? And we're not cutting it to zero. I mean, you can do that, but it's specific situations apply. So like if you're a real estate investor, it's very easy to cut your tax bill to zero. But if you're an independent contractor doing a thing, consulting, you're a life coach, you're a graphic designer, you're providing some service out into the world. Usually the optimum thing to do is to cut it 20% is kind of a number we see a lot. And so if we take 20% of your year, that's 74 days. So that's 74 days that you currently are spending working for the government. Might be local government, might be state, might be federal, but one of those. And instead we shift it so that you're working for yourself during that time. And what you do with that time is up to you. You go on more vacations. You can reinvest that time into your business. You can you just blow it all. It doesn't actually matter. As long as you're making the decision, that's a win in my book. So that's really the root problem, is that you are spending 74 days of your life every single year that you don't have to working for the government when you should be working for yourself. So to me, that's the root problem with overpaying on your taxes. But let me know what you think, and you can leave comments in the what do you call it, in wherever you're watching this, whether it's on YouTube or LinkedIn or whatever, or you watch the replay later on. So I'm curious about what everybody thinks the root problem with overpaying on taxes is. All right, but that's my take anyway. So I have the answer to all tax questions. So you can after this you can turn off this and you can say, I know everything there is to know about taxes, because the answer to my question is It depends.
It depends.
So it depends on, in the tax world, we have what's called facts and circumstances. So everything depends on facts and circumstances. What is true for you is not necessarily true for somebody else. And it depends on what's going on. So my favorite example lately is the 1099K. So the IRS backed down on this again for a second year in a row, but there was a law passed back in 2021, I think, that changed the reporting rules for 1099Ks. So a 1099K is a third party transaction report. So this is a payment platform. Like if you accept Visa in your business, Visa issues a 1099K at the end of the year. They say this much money flowed through our system on behalf of this taxpayer over here, and they break it down by month, and they show you how many transactions there were total. And under the old rules, it was if you had over 200 transactions during the year and the total dollars transacted was greater than 20,000. If both of those things were true, then one of these reports was generated. So that was the rule for decades, and the rules were changed so that now the new rule is forget about number of transactions, doesn't matter, it could be just one, and then the dollar threshold is 600. So they backed down back in 2022, and then at the end of 2023, they backed down again. And they keep saying, "Oh, we're working on implementation," and it's just going to be a nightmare, basically, because payment platforms are all kinds of things. So Visa and American Express and Mastercard, those are all payment platforms. But so is Venmo and PayPal and Zelle, and so is Airbnb, and so is VRBO, and just any app that you're using that somebody puts money into and somebody else on the other side gets money out. That's a payment platform. So the problem with that is that people use these apps like Cash App, you know, all the time for things that have nothing to do with business. So if the payment platforms have to generate millions of these 1099Ks now, and they're like, okay, Joe got $700. What does that mean? Right? Nobody knows because it depends on the facts and circumstances. So maybe $700 was actual income. Maybe it was a loan from your brother. Maybe it was your friends reimbursing you because you picked up the check for dinner, and everybody just cash apped you the balance. You know, we don't know, and that's why it depends. People think accounting is very black and white, and if you don't know anything about accounting, I can understand why you think that. But really, these are all decisions that need to be made as far as how things are categorized and how things are treated and what kind of lifetimes these things have. Currently, there's a bill in Congress talking about the R&D expenses and uh, uh, refiguring how those are written on tax returns, because there was a law change last year where if you had R&D expenses, those had to be capitalized over 5 years, and you got a credit for them in the first year, but the credit plus the 10% that you got in that first year of actual write-off did not make up for the fact that you lost writing off the full amount. So people ended up with much higher tax bills who were taking R&D credits than they would have otherwise. So these are questions that's like, what is appropriate for these type of expenses? Does it make sense to spread this expense out over 5 years? Does that match? There's another accounting principle called matching. Does that match with the expected value creation from that particular expense? And so all these things go into it as far as how we characterize things. Um, and it depends on a lot. so
Right.
so but that's the answer to every tax question. I know it's glib, but it is true, because when people ask me stuff, it's like, well, it depends. And if I have time, I'll go into what it depends on.
Right, right.
But Serena, I know we have a bunch of questions teed up already, so why don't you hit me with the first one, and we'll actually dive into the whole office hours here.
Alrighty, alrighty. So the first one is, what are the key changes in tax laws this year that could affect me?
Mm. Well, the big one is this American Relief, Tax Relief for American Families or Workers Act.
That's
So
true.
that has not passed yet, but it has passed the House. It is expected to pass the Senate here, and this started in the middle of January, and we were hoping to get it. They would get it done before the IRS opened for last a week ago, but they didn't. So they're still working on it. And the big thing here is that there's kind of three main things. So one is that they're going to be changing the child tax credit. So it doesn't affect 2023 so much because right now we're starting to file 2023s, but 2024 going forward, the child tax credit will be automatically increased. And the child tax credit has two parts. One is non-refundable and one is refundable. Refundable means that you have, even if you don't owe any taxes, you'll still get cash back from the government. Non-refundable means it will go against whatever tax you owe. So the refundable part is the extra part, which people like. so
Right.
so that will be increasing, um, and the it'll be easier to get that going forward. So that's one element. Another element is the R&D. So fixing this expense versus capitalize over 5 years issue, and it's going to be retroactive according to the last time I read the bill, to 2023, so that all the 2023 tax returns we filed, we'll have to amend showing that the we're not amortizing over 5 years. We're instead going to expense in the first year, and that will change a few people's tax situations in a major way, and they'll be super happy about that. Um, what was the third thing that I said? R&D. Oh, the bonus depreciation. So under the Tax Cut and Jobs Act, which was Trump's tax reform, there was this concept, or this reintroduced concept, of bonus depreciation. And bonus means that you get extra. So you were able to write off assets that normally you'd have to capitalize over 3 years, 5 years, 7 years, 15 years, and you were able to capture it all in the first year. And the way the Tax Cut and Jobs Act was written, that starting in 2023, instead of getting the full amount in the first year, it goes down to 80% in 2023, and then 60% in 2024, then 40% in 2025, and then it just goes back to regular in 2026. So what this bill is doing is it's extending the 100% bonus depreciation all the way to 2026. And that's going to be a major change. Because if you have assets in your business, this was a great write-off that we were able to use over the last, however many years. So, and this is the thing with what used to be called voodoo economics, where Congress passes these laws, and the voodoo is like you have these sunset clauses where it's like, okay, we're passing this bill now, but in 10 years we're going to ratchet it back down, and we do this in order to get the budget projections to work out the way we want to. None of that ever happens. So because when push comes to shove, people don't want to give up their tax breaks. So when they realize they're losing 100% depreciation, the lobbyists go to work and say, hey, we want to keep this. And then Congress passes another law. And then, so whatever that plan was 10 years ago, it just it never comes to fruition, because the next Congress or the next one or the next one can just change their mind and do something else. So you always have to be really careful with that when these kind of provisional tax changes are in place, like the Tax Cut and Jobs Act was. Um, so yeah, so if your business has any kind of assets that it buys at all, could be real estate, could be equipment, could be furniture, it could be all kinds of stuff. Um, then we are assuming this bill passes. We're going back to fully bonus depreciating it in the current year, rather than 80% and then the 20% the next year. So that would be a good change. And there are other things in the bill. There's a bunch of stuff for dual citizens of U.S. and Taiwan. There are a few other things that aren't terribly relevant to most people, but that's the biggest change that is happening right as we speak. But without that, then the biggest change is the losing of bonus depreciation for 100%. And yeah, I would say those are the largest issues. So I hope that is clear. I know it's kind of a lot. It's all over. This is part of the problem with tax legislation, is like I had one guy, we were doing some projections, and I gave him a spreadsheet, and he says, well, where are the formulas? Because I just had numbers in the thing. And I was like, well, there are no formulas. That's not how taxes work. There's no overarching, guiding principle. This is just like, this is what Congress has decided, and we got to do our best to work with it. And this thing gets added to that, and that thing gets subtracted to that, but only if this thing over here, so it's a lot of conditional sort of things that you got to actually, do, tax return calculations in order to come up with an answer. Um, but yeah, it's keeps us it keeps us busy.
Yes.
All right. So what's the next question?
The client asks, how can I optimize my tax situation if I'm self-employed or have a side business?
Yeah. So generally,
Mhm.
well, one, you should go watch our webinar that we've done on our four-step process that goes through all that. And the um, the general guideline, and this is not true for everybody, but it's true for most people, is you're going to want to switch your company or your side business to an S corp. And there's a lot of reasons for that. I don't know if I wanted to go into all the details right now, but basically, it lowers your audit risk by a factor of 10. It allows you to avoid at least some portion of self-employment tax, which is, a huge tax. It's 15.3%, and it's flat up to 170,000 or so. And it allows you to take advantage of certain tax strategies that you can't do otherwise if you keep like there's 23 million small businesses in America that are filing Schedule Cs, and Schedule Cs are like horrendous.
Mhm.
they're they're for people who don't know what they're doing, basically. Which apparently there's 23 million of these. So there there's almost no situation. I won't say no situation. There's almost no situation. There's a couple where certain jurisdictions have certain penalty taxes on S corps and things. Where, but other than those specific situations, it's always better to run your business as a separate business and not as part of your personal taxes. And so, generally speaking, a company can file a 1220. That's a C corporation. That's where it files its own tax return and it pays its own taxes. And then you get a dividend, maybe if you want to take money out that way, or maybe you get a salary. You can be an S corporation. S corporation also files its own tax return, but it's a flow through. So it has income, it has expenses, it has a net profit at the bottom. That net profit flows through onto your personal tax return, and it does not have self-employment consequences, meaning that whatever that flow through is, you do not pay 15.3 self-employment tax on. And also, you get qualified business income deductions on that income, which is great, and which is worth up to 20% of the income. So if you have $100,000 worth of flow through income from an S corp, then if things are maximized and optimized, then you're only going to pay tax on 80 of it. So you get a 20% break on the tax from that income. To get money out of that, you pay yourself a salary or you give yourself distributions, and the distributions are not taxable because it's just part of that flow through. So the other common business entity structure for businesses is a partnership. This is 1065, just the form. It also, like an S corp, it files its own tax return, it has its own income, its own expenses, and then the bottom number flows through. Now, the major difference between partnership and S corporation is that on a partnership, that flow through does carry self-employment tax. On a S corporation, it does not. So major difference. And partnership, obviously, the name implies you need at least two people involved. You can't just be a solo partnership, because that's a contradiction in terms. So by and large, most people, S corporation is going to be the optimal way to go. And then as far as so doing that right there, that's kind of step one of tax strategy. And about 90% of the time, that's going to be the way to go. So that's going to cut down on your taxes from self-employment tax, and it's going to reduce your audit risk. And I've got a whole thing on the Schedule Cs and why that's an audit target. But basically, the IRS performs these analyses every few years on where they think they're missing money, and they call it the tax gap. And the tax gap The most recent report has a $400 billion tax gap that IRS thinks they should have been paid and weren't. So 30% of the missing money, according, missing in the IRS's eyes, is from this one form, which is Schedule C on your 1040, profit or loss for business. And so if you are one of these tens of thousands of new revenue agents that's being hired by the IRS, and your job is to go after people who are not paying, their fair share, whatever that means, is that where are you going to go? Well, you're going to go where the money is. so, if 30% of the money is in this one category, you're going to spend at least 30% of your time doing that. So, the by getting that activity off your tax return, you're going to save yourself, audit headaches in the future. So that's step one to tax optimization. Once you're into an S corp, then there's other things you can do. You can do meeting strategies, you can do reimbursement strategies, you can do salary optimization, you can hire your kids. Hiring your kids gets a little bit more complicated because that has to be in a partnership and not in an S corp. So you need a separate entity. But and then you can do retirement planning if you like. So there's a lot that goes into it, and I've actually come up with, so like internal to the Tax Sherpa team, we have this master planner template that we use, and I'm actually starting to make it available to people. So stay tuned for that. We'll go over that at the end. But yeah, that's kind of the first few steps for optimizing your tax. And it doesn't really matter if it's your solo business or if it's a side business. There's a couple key things you got to be careful of when it's a side business, because side business means you got income from somewhere else. So you have a day job. So if you have a day job, then typically your side business is going to run at a loss on a tax basis. And that's if you do things right. so, um, so then on your tax return, you'll have W-2 income on line one, and then you'll have, business loss coming through schedule one. And that'll be a minus sign. And so when you're constructing that tax return, you have to keep in mind to yourself that, there are practical limits in that situation, because, if you are receiving a W-2 from a third party company, meaning that you don't own that company, then your standard of living is going to be based primarily around that. And so if you go too far on the loss side, then you're going to actually increase your audit risk rather than decrease it. So there's a balancing game to be played there. So like I see these guys on TikTok, not on TikTok, on Instagram. I'm sure it's on TikTok too. I don't actually have TikTok.
Yes, definitely on TikTok.
Where it's like, so what I see these guys say, what I have my high earning people do is I have them go buy a house and put it on Airbnb, and then we get huge deductions. That is true, because what happens is if you have a rental property where the average length of stay is under 7 days, then you're no longer being a passive landlord. You're being an active business. So you're running a hotel essentially, and like a hotel, there's two parts, right? There's the building itself, and then there's the business activity of managing hospitality. So once you do that, then you become active, and then you get active losses as opposed to passive losses. Active losses are unlimited, and they can go against your W-2 income. So if you have, let's say you have a W-2, you're doing well, you have make 150K, but then you buy an Airbnb house and you buy it for 500K, and you do a cost segregation analysis on it, you get $100,000 deduction out of it. So now you went from 150, now you have a minus 100, and so now you're down to 50 on your tax return. That's great, right? Your taxable income is reduced dramatically. Your taxes go way down. Super. Until you start getting letters.
Right. It's the letters.
and then you get letters from the IRS saying, hey, we need you to substantiate all this. And that's the beginning of the audit process, is you get the letter. So the when you go out of whack on your ratios like that, you are vastly increasing your chance of getting one of those letters and starting yourself an audit. Because the question that comes up in the IRS's computer mind is like, okay, so you have $100,000 loss. What are you living on? You're in this zip code, and you're paying this mortgage, and you're doing this over there. It's like, where's the money coming from to support your lifestyle,
Right.
And so there's kind of two schools of thought when it comes to this issue. So one is that I'm going to do everything that is legally within my right to do, and to hell with the IRS. And method or stream of thought number two is that it's not there's a certain amount I'm willing to do in tax strategy, and then if it goes too far and triggers audits, that's even if I'm right, that's too much hassle to deal with. Because the process is quite painful, even if you're right.
Mhm.
And
Even if you're right.
so there we've had, I've talked to many people over the years, and a lot of people say, well, I could fight this. It'll take me, 100 hours of work going back and forth, the whole thing. And if I'm right, then I made, $12 an hour. So a lot of people, just elect to just pay it, and it's very extortion-y kind of feeling about it. But this is the same thing with frivolous lawsuits, where people, shake down companies. So you got to make your own decision about that. Um, so when you have that side business, you just that's the main thing you want to be careful of. It's like how far do you want to push it, and do I want to do it in a way that could cause me more trouble, or do I want to stay in a more conservative zone? That's a personal decision. I mean, you're entitled to all the tax benefits that there are, for sure. But it's just in the real world, how far do you want to push that line? And those are things that we talk about with our clients, as far as what their individual temperament is, and how they want to do. And I'll tell you, 95% say, well, let's just back off and not have
Yeah.
any issues. And it's like, okay, and 5% says, let's hit them.
Let's do it. Let's do it right now.
Hey, as long as we've dotted our I's and crossed our T's, then great, let's do it.
Yep.
All right.
So we have another question from a client
Yep.
saying, can you review my previous year's tax return for any missed opportunities or errors?
Yes, we can. So there's often a lot that's been missed. We talked to just over the last week. We talked to two different people. Where one we found by the time everything was said and done, it was about $40,000 in missed tax savings that we're able to get for them. The part that kills me about that one though is that even though we're having a great result, we're getting $40,000 back. It could have been more, and it could have been more if we had done the setup. If like he wasn't a client then, but if we had him back then and we had the setup correct, um, as far as like optimizing income and the QBI and all that kind of stuff, would have been, instead of 40, it would have been 7. So that's is what it is. But some things we can fix. So yeah, a lot of times there's times to go back and review things and you know add things that were missed, but some things are fixable and some things are not.
Sure.
It is certainly worth a review.
Mhm.
So if anybody watching has that question and they want their stuff reviewed over the last couple of years, you have 3 years in order to do it. So um, the the I love the way the rules are written. So you can file an amendment as far back as you want. However, if it's past 3 years from the filing date, then you'll get a nice letter from the IRS saying, "Hey, we processed your amended return, and you were owed such and such number of dollars, but since it's past the statute of limitation, we're not going to pay you."
It's
So
crazy.
so right now we're coming up on April of 2024, which means that the year that is closing is going to be the year that was filed in April of 2021, which was the 2020 tax year. So 2020 right now is the last tax year that you can amend and still get money out of it. So you could amend 2020, 21, 22, and then we're filing 23s right now. So those are the open years. And so you have 3 years to go back on them, and the IRS has 10 years to go back on you. So
That's
statute of
crazy.
limitations. Yeah.
Crazy.
Yeah. Guess who writes the rules, right? So yeah, the statute of limitations on the IRS coming back after you is 10 years. In practice, they really only go after 6. That's by internal policy. And then in terms of real life, typically they're only going to look at the last 2 to 3 years. So that's kind of the window that you're always working with. So if you've heard people say that you need to keep 7 years worth of tax returns, it's because of that 6-year window. That's the IRS policy. Now, professional tax people, we have to keep our stuff for 10 years because that's the actual statute of limitations. Um, and then you have, people who, like, my dad has a he just turned 81, and he's got a shelf, on a bookshelf that's all just binders of tax returns. He's filed since like 1970 or something. And actually came in handy for him once. So quick story. Um, he, I didn't know this till years later, but apparently he got audited one time, and it was because of Schedule C actually. And this was before I got into the tax business, and told him, what he was doing was nonsense. But 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 he got audited for Schedule C, and so he goes, and he's retired, so he's got nothing else to do. So he's like, yeah, I'll go down to the office and talk to him. And so he goes down and he brings his boxes of tax returns, and he puts them out on the desk for the agent, and he says, I've been filing this way you don't like, here since 1973, and you've accepted every single one of them. So what's wrong with this one? And according to my dad, the agent just kind of looks at the stack of stuff, realizing he's got way more trouble on his hands than it's worth, and just says, okay, just go home. We'll leave this alone. And so I think there's definitely an internal list that revenue agents have in different offices of like, okay, these people are just more trouble than they're worth. So let's leave them
Right.
alone. So yeah, so having decades worth of tax returns can come in handy. Uh but
So funny.
yeah, it's just
It worked though for him though.
it did work. And he hasn't been audited since. So there's that.
Wow. So, Neil, we have another question.
Mhm.
What are the tax considerations if I plan to buy or sell real estate?
Well, we're talking investment or for personal use.
Both.
Okay, so for personal use, the the greatest tax break that there is the personal exclusion. And so if you live in a residence for 2 out of the most recent 5 years, and then you sell that thing, then if you're single, you have $250,000 worth of gains tax free. If you're married filing joint, you have $500,000 worth of gains tax free. It's the single largest tax break available to most people. And so most people, by and large, do not pay any taxes on personal residences because of this rule. And a lot of people get confused with like, well, if I bought another house, then I'm rolling it over. It's like, well, that whole concept does not exist for personal use. It's investment property. You can do that, and that's called a 1031 exchange. So with a 1031 exchange or a like kind exchange, what you're doing is you're taking one investment property and you're exchanging it for another investment property, and you're not taking personal benefit of the money. You're just rolling it over. So in a like kind exchange, it's got to be investment property. There's timelines and limits associated with it. And then you just defer the taxes until you sell that next property. And then you could roll it over again if you want to. You could keep doing this. And people make whole careers out of rolling over 1031 property.
That's crazy.
And the and as you go, you know, you access the capital through loans. And loans are not income because you owe it back, and you've got to service the debt. And if you're an expert at this, you buy property, it increases in value, you roll it over. You buy a bigger property, it increases in value, you roll it over. And all the way you're making monthly income on whatever the rent is. And you're accessing capital through loans. You can't get the full amount out. Usually you can get like 70% ish of the value out. And you just keep repeating this, and then you die, and then your estate has to deal with whatever the remaining issue is. And if it's under the estate exclusion, then it's tax free. So that's kind of the traditional real estate investor plan. Otherwise, if you don't do the rollovers for investment property, then you're going to have a capital gain, and there's going to be two components to it. So component number one is just the profit, right? So I bought a place for 100,000. I sold it for two. Let's say I bought it for 100. I sold it for 150. That's $50,000 worth of gains. And whether it's less than a year or greater than a year determines whether it's short term or long term. Short term means that you're paying your regular rates as if you had a job. So if you're in the 37% bracket, you're going to pay 37% of the money. Long term, you get a discount for investing capital into the wider economy and letting it sit. So the capital gains rates are either 0, 15, or 20%. At least those are the current rates. That has changed historically. All rates have changed historically. So so 0, 15, or 20, depending on how much total income you have for that year and your filing status. And then if you're over 250K of total income, then you have Obamacare taxes, which is another 3.8%. So so that's element number one. And then the element that gets people with investment property that they get surprised by is the recapture tax. So recapture is, so you've owned this thing, let's say you've owned it for 10 years, and each year you were writing off $5,000 with depreciation. So now you have $50,000 with depreciation you wrote off over that time, and that has to, when you sell it, you get to recapture all that value. And so there's a recapture tax. And that recapture tax is usually 25%. So if you have 50,000 worth of capital gain, maybe that's 20%. You get another 50,000 of recapture, that's 25%. And so the total is going to be the sum of those two. So that's what happens when you cash out and you take the benefit. If you don't need the benefit, you don't need the cash, roll it over, and assuming you still like real estate. Anyway. Some people have had situations where it's like, okay, we did this whole real estate thing, wasn't for us, and so let's sell and just be done with it. And then there's nothing to roll over to, and then you have to take the tax at that point. So, all depends on what your situation is, but that's kind of the generalities of what's going on with real estate as far as personal versus investment, and then the different types of investment, and then the recapture and all that kind of stuff. So hope that was clear. I know there's a lot of different subcategories in that, but yeah, that's the basic idea.
So we have another question here from a client. So the question is, what retirement planning strategies should I consider to minimize my taxes?
Well, so I, how do I say this simply? So retirement planning, there's many different types. So there's tax advantage, there's tax free, and then there's after tax. So when people talk about retirement plans, generally they're talking about the tax advantaged, the tax deferred stuff. Like, so your 401ks, your 403bs, your 457s, your SEPs, your IRAs, those are all tax deferred, meaning that you put money in now, and then you get a deduction on the amount that you put in, and then the investment account does whatever it does, and hopefully it grows over time. And then when you start to access that money, it then becomes ordinary income at that future date, and you pay taxes on it when it comes out. So that's kind of the standard approach. And there's two components to most of those plans, and one is the employee contribution and the employer contribution. So the employee contribution changes every year, and I think this year's 21,000 for 401ks and 403bs. I'd have to check that actually. That might be 22. But so that's the employee contribution. That's the amount you can deduct from your own paycheck. And if you own your own business and you're employing yourself, then you have a lot of control over how that works. And then you have the employer contribution. So the employer contribution can be any amount subject to certain limits, where you have a total limit of 66,000, including the employee contribution. You have another limit on most plans like 401ks where the employer contribution is capped at 25% of the employee's wages. And as long as those two conditions are met, then the employer can chip in however much they want up to that. So if you're working for a big company that you don't own, usually you'll see things, oh, we have a 3% match or 2% match or whatever. And that's their level of employer contribution. But if you run your own company, then you have a lot of flexibility, and depending on how much money you're making, you can sock a whole bunch of money into a retirement account tax deferred. So when you're looking at that, you have to look at current year reduction in tax versus investment and growth, and then future tax bill there. Other things like so Roth plans are after tax, so you can have a Roth 401k, you can have a Roth IRA. This is where I'm taking the tax hit now. I put whatever my limited amounts are into the plan, and that grows. And then when I take it out, it's tax free. So they're mirror images of each other. For traditional, take the tax deduction now, invest it, take the tax hit later. Roth, tax hit now, you invest it, and you have tax free later. So that's kind of the two general flavors you'll hear a lot about. And you can get a lot into the math of what you think is going to happen, what your expected returns are, what the future rates are going to be, what your future income is going to be, all these kind of things to model out what you think is the best way to go. But that's only two of the retirement situations. Then there's other things. So there's actuarial plans, so defined benefit plans where you can put up to, if you're making enough money, you can put up to $250,000 a year into these things. And you have to sit down with an actuary that looks at your life and underwrites a benefit plan for you to create a long-term stream of income in retirement. And the general umbrella you'll hear for that is qualified retirement plan, or QRP. And then on the other side of the spectrum, there's a lot of things you can do with like life insurance and other kinds of things where you, similar to a Roth, you take the tax hit now, you fund policies of various kinds, and then that grows. And when you access that through loans in the future, then those loans are tax free. Or you just do none of the above, and you say, I'm gonna take all my income now, pay whatever taxes I do, minimize that as much as possible, and then invest in whatever I like. You could do stocks, you could do real estate, you could do crypto, you could do buy a business, whatever it is. So and that is, while not specifically a retirement plan, it is an asset building plan that should hopefully help you out into retirement. So there's a lot of different ways to skin a cat, and I've done a lot of analysis on stock investments as far as putting money into a tax deferred plan and just taking it out and paying taxes and then putting it in a regular brokerage account. And the advantage is not terribly clear. So it depends on what your assumptions are. But if you tweak it a little one way or a little the other way, one way comes out better than the other. So you know, there's in the retirement planning venue, specifically, people let the tail wag the dog a lot, where they're saying, "Well, I get giant tax deductions." You do, okay, but is that actually worth doing the things that you are doing? Because philosophically, my biggest problem with retirement plans is that you're locking up the money into this bucket of money that you can't touch. And if you do touch it, then there are penalties, unless, until you're 59 and a half at least. And then, is that current year savings worth doing that? And given that the returns are not guaranteed by any means, and even under the optimistic assumptions are not as, dramatic as people like to think, then, I don't push them, because it's very individual. As far as how people have viewpoints on what is going to happen into the future. So, but we can walk through the math on those. If somebody has a specific question and wants to hop on a call, if you do want to hop on a call, go to taxsherpa.com, click the book an appointment link, and you'll get on the calendar for one of our tax experts, and we can go through all those things. Probably not live, but you could ask your questions, and we could figure out what your situation is. Then we go to our we have tax team meetings every day, and we can sit down and kind of go over your situation and work through the math of how all that works and get back to you. But yeah, taxsherpa.com, book an appointment.
Today.
Yeah. So let's do one more, and then we'll wrap up because we're coming up on the hour.
Okay. So another client asks, are there tax efficient ways to save for my children's education?
Somewhat, yes. So the standard answer is there's 529 plans, and there's Coverdell IRAs. So 529 plan is a state-sponsored plan. different states have different versions of this, and it doesn't have you don't have to use the one that's in your state, although most people do. So like Florida has a program where they, based on your child's age, they fix a the cost for a 4 year or 2 year or 4 year with dorm or 4 year with meal plan, and they've got a couple different options. And they say, okay, based on your child who's 5 years old, then we're gonna say in 13 years that college is going to for college for a Florida, you know, Board of Education college is going to cost this. So we're going to lock in that price right now. And um, and then you pay that either one lump sum for over 5 years or whatever. And so that's one type of 529 plan. Another type is basically they just create an investment account for you, and you just put money into stocks, and you're going to get whatever you get out of the market. And then there's hybrids, and then there's a couple other variations. But so federally, there is no deduction for a 529 contribution, and uh, on some states there is, but it's small. so you're going to have limited success there. Coverdell IRAs, which is basically you can put in 2,500 bucks per kid into one of those. It's kind of the same situation. Then there are other considerations to consider, where the if you go for financial aid in the future, one of the things that comes into it is how much money do these plans have. And I was actually going to be setting up an investment account, just a traditional brokerage account for my kids under UTMA, Uniform Transfer Minors Act. And I found out that if the kid has an UTMA, that counts against them for uh, for college financing purposes. So if the money is in the parent's name, then it doesn't count against the kid, which is bizarre to me, but is what it is. So yeah, the tax benefits for college savings there's depends on where you live, and they're not huge, but it can be done. Um, so if we think about this more broadly, we could say, okay, let's say I'm a real estate investor. I have rental properties, and I buy this rental property, and I earmark it for my kids' college. So then I'm getting all the tax benefits of real estate. And, in the future, I sell the property or refinance or whatever, and that pays, for the college. And so it's not a college savings plan specifically, but it is a way to save for college in a tax advantage way. So, and you could do that, it could be a business, could be, whatever. Real estate is just an example. But yeah, you want to think about these things a little bit more broadly than the product that the financial planners say, here, you could save for retirement, save for college in this thing. And then if you don't use your college, well, then you have to pay taxes on it. So
Yeah, crazy.
yeah, so that's kind of the short version of that. So with that, we are coming up on the hour, and I did want to take a second to talk about next steps. So for everybody who's following along, next steps. So there's two things. So one is we do these lives every week. Sometimes we're doing office hours like this. Sometimes we're doing more structured presentations. The most recent one was about our 4 tactics to save $18,179. And you just go to taxsherpa.com/live, and I actually have not updated for the next week, but tomorrow morning I'll update that link, and you'll be able to go there, and it'll take you to the registration page for that for next week's session. And then the other part is, I was telling you about our templates. So you can get our fill in the blank templates that we use to plan for all of our clients. And this is really applicable if you only have a day job and nothing else. It's not for you. This is for people who have their own business, or independent contractors, or solopreneurs, and they want to save on their taxes. It'll step you through the different tactics that we use in order to save tons of money on taxes. And each part, so you get the worksheet. Inside the worksheet, there's videos along with how to fill out each second of the worksheet. And this is the stuff that has taken me years and years to develop, to the point where it's like a cohesive system rather than just like this thing over here and that thing over there. But now, we've really honed in on on how this can work for, 99% of businesses, really. So you get that, you get the business base camp tax guide, and that's kind of stepping you through like why we are doing the things we're doing, the flow of funds, how that all works, and just kind of like it's actually a seven page document that I ended up writing, just kind of giving you the overall basics of how and why to use the templates. And just as an extra, I threw in the tax filing checklist to avoid red flags with the IRS. You can see that image down here. So it's just like, who's carrying around that giant red flag? But a lot of our clients do when they file their tax returns because they
Yeah.
don't know. And there are a bunch of different things in a bunch of different categories. Like, check this, make sure that's right. A couple gotchas that you'll find, especially if you're a small business person. And we see a lot of times, here's just one of the things to check, is the is 1099s, making sure that you have the right number on it. Not just the dollar amount, but the taxpayer ID number. Because what a lot of small business people do is they'll sign up for something and they'll put their personal social, not realizing that it should have been their LLC's EIN. So if you do that, there is a way to fix it, but it has to be done through what's called nominee income, where you are declaring on your tax return, yes, this money came to my social security number, but it was on behalf of this entity over here. And by the way, here's the filing for that. So you wanna make sure that you have all those things, matching up, and just goes through a whole laundry list of stuff to make sure that you aren't raising any unnecessary red flags. So if you want to do that, go to taxsherpa.com/templates, and that'll take you through the whole thing. And if you want from there, there's also a private group you can join where we get together once a month on a Zoom call, and I actually walk you through how to run the template for your business. And not only will you save tons of money on taxes, but you'll actually run a better business. And when we get into the call, our next one is on February 15th for that. Um, when we get into that, you can actually see how by paying attention to your business and working on your business, your operations will work better and you'll end up making more money anyway, which is actually the whole purpose. I mean, in the 2 minutes we have left. So the Internal Revenue Code is a series of carrots and sticks. It's written by Congress, and it is we want to punish the things that don't provide a special value to the country as a whole, and we want to reward the things that do provide value to the country as a whole. And so all the tax breaks that are there in order to make more money, because you're being more productive into the economy and things are getting better for all Americans. That's why tax breaks exist. Like if you look at the master tax guide that gets published every year, the first however many pages, 30, 50 pages, are all the tables. So if your income is this, if your filing status is that, but your tax bill is this. So the rest of it is all the exceptions and the wherefores and the different things that can be done. So, and it's an 800-page book that's gets published every year. So, you always want to think about that in that context. We had somebody ask us the other day, lawyer fees. Are lawyer fees deductible? It's like, well, it depends. So, a divorce lawyer, no. Personal injury lawyer, maybe. Uh, if you're suing somebody because you had a business deal and they reneged and you're going after your income, then yes, that is deductible. And the reason that's deductible and a divorce is not is because one is in pursuit of more income, and divorce is just holding on to your stuff basically. So it's all the tax incentives that exist are there in order to further your business. So if you are structuring your business in the right way and you're operating your business like a professional business owner, then you get all these tax breaks that we go through in the templates. So, and just as icing on the cake, so Serena knows I have this business coach, and I told him my idea for all this is like, oh yeah, that should be $300 a month, and so you're not gonna pay $300 a month. You can get all my templates, all the videos, the business based camp tax guide, and the tax filing checklist for a measly $7. So if you want, go to taxsherpa.com/templates and you can buy it there for a whole $7. And we'll
You
see
need
you.
it.
You do need it. But that wraps up this week, and we will see you next time.